I think we're going to go ahead and get started here. This panel is best practices for a successful capital raising process. Obviously critical for all of our independent sponsors and capital partners as well. So we'll start with brief intros and then we'll jump into it. Greg
Robinson, RLG Capital. We're based in Park City, Utah. We've been in existence for about 8 years. We've deployed about $450 million into 25 different investments. We're currently focused on control acquisitions of businesses between 2 and 10, platforms typically 5+ of EBITDA and add-ons of 500,000 plus. And we're active, as many of you are, trying to get 3 different acquisitions closed before the end of the year, plus a couple of recaps of portfolio companies. So pleasure to be with you.
Hi, Jennifer Stewart. Pleasure to be with you guys as well. JStar Holdings and affiliates. We've been investing in the independent sponsor model for about the last 15 years. We've deployed about $500 million of capital in over 20 acquisitions, including add-ons, and have been really industry agnostic. We've primarily our portfolio has been focused on consumer brands, healthcare, and niche manufacturing and services.
Hi, I'm Ariz Dastur. I'm subbing in for my partner, Neel, just why I don't look like the person in the picture. We started our firm in 2017. We're an independent sponsor. We've closed 3 transactions since starting and have a pretty active pipeline right now. 3 sectors we focus on. One is multi-unit, the second is healthcare, and the third is technology. Typical companies anywhere from 3 to 20 million of EBITDA. Look at that full range, and we'll do both kind of minority growth investments as well as majority recaps.
Hey everyone, Mike Lonergan, Georgia Oak Partners out of Atlanta. We focus, well, we're about to close our 7th company with a couple folks in the room, knock on wood, along with McGuireWoods help. We focus really in 3 sectors: manufacturing, business services, and consumer services. And size range really in the $3 to $10 million EBITDA range. And what we're trying to do is really build relationships directly through a lot of good times and trying to forge friendships with business owners is probably first and foremost.
Matt Pettit, Seven Hills Capital, and I'd kind of copy that it's really what we're trying to do is build a few healthcare service companies focused on very niche parts of healthcare services. Have been lucky enough to partner with some of the folks in the room here. We're based in Chicago and Nashville. We have people in both offices and are trying to really build a few companies that lends itself well to the independent sponsor model with not the ambitions of building a big portfolio, but being very concentrated with a buy and build strategy.
Great, thanks. For a lot of the people, we're here in 2019 where our keynote was Tim Sanders. And what he talked about, as some of you recall, is being a love cat and really just how do you build and nurture relationships. So I thought as we talk about capital raising, so much of that is relationship based. So maybe starting with you, Greg, how do you think about your relationships and how do you build those relationships?
Thanks, John. So one great way to do it is to come to this conference. Many of you, I think, were here previously. We were here for the first time 2 years ago. We were impressed back then, but we've progressed from cubicles at McGuireWoods to tables here in the ballroom. It was the app worked. It was really great. My voice was sore by the end of the day yesterday. It's recovered a little bit today. But it's great to have a conference where independent sponsors and capital providers can come together. There's a real energy, I think, that comes from the entrepreneurial spirit of America. It's the lifeblood of this country. And so I think relationships start with wanting to contribute to grow something meaningful. And finding people, since we're talking about capital providing, people that have had some level of success, that are looking to participate in future growth opportunities, that have some capital to deploy. I think it's really critical to get to know what they care about, what their interests are, and then to try to match opportunities as they develop that fit those interests, and then invite them to participate and let them decide for themselves, not be too heavy-handed in the approach. I think it's really critical that you keep those relationships going, that you're continually adding to them. You never know when you might find someone and a relationship that might really develop. In fact, I'll just give an example. So we met Trinity Private Equity Group here 2 years ago. Justin Burkhart and I at the table right around like there. And we weren't scheduled to have a meeting. It was an impromptu conversation, but we've ended up doing several deals with Trinity, and we're doing 2 add-ons and a recap right now with them. So sometimes, you don't know where the relationship will come from. And I think it's also important that you've got people wanting to write different size checks and looking for different types of opportunities so that you can match them to what you're doing.
That's great. And everyone else, feel free to chime in. But Mike, I think you guys over the years have taken a really creative approach to how you build your relationships with different capital partners. Maybe talk a little bit about the impetus to that and what you look at.
Yeah, it's funny you asked that because I happen to have an answer right here. So if you've done 0, 1, or 2 deals, this answer is probably for you, and the rest of you can probably just check your phone or look at sports scores. So if I were to go back a few years when we started the conference, John, and Georgia Oak was kind of in its early innings. First thing I would do is really create a database. Sounds obvious, but frankly, if you need an intern or 2, get them on board. Scrape down everyone in this room. Other conferences out there actually advertise. Who's going to their conference. Got to go. Scrape that down too. And you'll see it becomes very evident who are the folks that are doing deals that are really at these conferences in numbers. So that's the first thing we did is we really, I think, know the market. Second is we hit the road. So, we COVID aside, travel a ton, going to New York, going to Boston, going to Miami, going to Chicago, saying, hey, can we stop in? Can we stop in? It's very easy for an investor to say, yeah, sure, come on in. You're going to be in Chicago. You're going to be, next door. Yeah, sure, we'll meet you at Starbucks. Make the ask very easy to engage that first little nugget with that investor. Third thing would be the way we present deals is typically through a pipeline. So rather than say, hey, we got a deal for you, we don't even know who you are, we met once 2 years ago, we got a deal. That's probably not how investors want to be approached. They're happy to see that, but the way we typically go after it is we'd say, hey, look, can we talk about the next year of our lives? What's going on, our pipeline, what we have active, and the next few things out there. I'd say then stay connected is sort of step 4. So we have every 6-week drip called the Acorn Insider. I don't know why, but it's called the Acorn Insider, and it's just a nugget of what's going on in our firm. So we talk about the live deals we've got going on. We talk about 5 or 6 things going on in our portfolio. Not sure how many of you guys read it, but a lot of y'all get it, and we're staying top of mind. So just kind of stay connected. Step 5 would be, I think, to consider a placement agent. We've had a lot of success with that over the last 16 months, and it's kind of helped springboard us. So you'll consider that to help you round out your relationship building.
And I guess a bit of a follow-up maybe to you, Mike, is just as you think about those relationships, so much of what we hear is capital partners underwriting the independent sponsor. What do you do? What do you think about when you're underwriting your network of capital partners?
So I think it's where you are in your cycle, right? So if you have just started and you haven't done anything, I'd go back and tell myself in that first inning, maybe go find a GP, go find a big brother, big sister that can help you kind of knock that deal down. We cobbled together a whole bunch of high net worth individuals, and it was a mess, and so I would consider you starting off there. And so once you maybe do a deal with a GP, consider going to like a model where it's more debt flexible capital. And then there you can move on to folks that are doing, they're not LPs, I call them IPs, they're involved partners, and so I think it's where you are in your evolution as to what bucket you want to go after and where you want to go. And so ultimately, if you want to raise a fund, obviously doing a ton of deals with GPs might not help you, but building those relationships up with folks that will support that effort will. So I think it's just making sure you're lining up the capital providers you're going for to where you are and where you want to get to.
That's helpful. Jennifer, as you think about on any given transaction, how do you decide which capital partners to reach out to on a particular deal?
Yeah, well, you really just have to sit back and understand what the deal is and what capital partners you've already built some relationships with that match with the industry and the investment thesis. So take a lot of time going through that database that you build up as you've been building relationships and really match up the fit, to the opportunity. We always too, whenever we're looking at a transaction, take a little bit of time to consider, is truly strategic capital something that could be really helpful as part of that transaction? If you're early in the sponsor evolution, it's to help you get that experience. You might be later in the sponsor evolution, but we've found some instances where we could really expedite and both the time, decrease the time to really realize on our value drivers on both the revenue and the margin side by partnering, with a strategic to move forward too. So it's really sitting back and really evaluating and being the matchmaker with all your relationships. And don't be afraid to, reach out to new folks too, if no other reason as to begin to build new relationships. There's no better opportunity than really walking somebody through a deal and why you think it's really interesting to begin to build new relationships as well. So, I think it's been set up here earlier, always continue to build your capital relationships. A new deal is a great opportunity to, those relationships that you haven't had a chance to really nurture, use it as thinking they might not really come through on this one, but it's an opportunity for them to get to know you a little bit better in the context of a deal and how you think about the opportunity.
That's great. Matt, as you think about your relationships, to what extent do you spend time developing that Rolodex of relationships to go to with a more challenging capital raise? There are obviously some transactions that are just down the fairway. You're going to go to your best relationships and you feel really confident in getting those. But to what extent are you spending time developing the relationships for more challenging deals?
We have taken kind of the same approach as you guys, where if we're in town, like if we're in Boston or Chicago or New York, we try and meet with as many people as possible. But for our initial underwriting of any opportunity, we do what we call a green light memo, which is taken from our former lives as funded sponsors. Where we'll write up 4 to 5 pages of why we like the opportunity, what we don't like about the opportunity, what we're concerned about. And we kind of send that to our core group of 10 partners, or pick that number on the front end to kind of solicit their feedback. So we've always tell them, like, a quick no or what are we missing is a lot more valuable than a very slow process and a challenging raise.
Sure. Arees, as you think back on the deals you all have done, in today's environment, I think it's a bit different as well, but when do you engage with the capital partners vis-a-vis your transaction? And just from a time perspective, how do you pull that together?
Yeah, I think every deal is a little different, but we've started tending towards engaging people after we have an LOI in place, ideally. I think we've met a lot of capital partners that say they want to see things earlier, they want to see stuff pre-LOI, and I think it can be helpful to sort of preview something with someone before you have an LOI in place. But I think we found that people really won't engage on the opportunity in any sort of deep way until you have it under LOI. And I also think if you're trying to run a sort of a competitive process to raise the capital, I think the LOI probably positions you better to do that.
Anyone on the panel do things a bit differently and go out a bit earlier in the process?
Yeah, we tend to go pre-LOI and try to soft circle the capital and have a sense for what the capital stack is going to look like before we sign the LOI, because then you're under exclusivity, you're on the time clock, and you're marching towards a close. So we want to be pretty organized and pretty confident about our ability to get that deal done before we dig in too deep. So that's what we typically do. But absolutely, I think, you also need to have a sense for what the LOI is going to look like. So you have to be in conversations with the sellers to the degree that maybe you're at the IOI. So you know what the range of enterprise value is likely to be. You have a sense for the multiples for that industry. So you know kind of where you're going to price it. And so you have to speak intelligently about the deal, but not necessarily with a full LOI in place.
Sure. And maybe
that's what I would say, John. Our biggest learning is when our first 2, we got under LOI before we want to raise the capital. But as we move forward, it's been important to us to green light the idea with trusted partners who, if you're negotiating an LOI, the last thing you want to do is settle on a tough point with the seller and then your capital partner can't live with it. So we've kind of changed our thinking there a little bit to try and issue what we call educated backable LOIs.
Yeah, that's helpful. And maybe as a bit of a backdrop for each of you to just talk about, as it relates to transactions, is most everything you're doing proprietary versus some sort of banker process? I think that kind of lays some of the framework for how you're thinking about things.
I think for us, if you're a capital provider and you're looking for an angle, you're looking for a story, because oftentimes you've got to convince the rest of your investment committee, folks that we'll never get to meet often, that this is a good deal. And so you have to have a replicable story that your advocate, your partner can then go tell their investment committee. And so if that story is, it's in a Harris Williams, I don't know why everyone picks on Harris Williams, but if it's in a Harris Williams auction, that's not a story that's going to really land well in that IC, that you're not going to be able to sit and say, oh, but because it's an auction, but we got Bob over here and Joe, and it's going to be great. So we skew heavily towards proprietary. It's part of our model. It's part of who we are. Very, very geographic focused, trying to build relationships with founders. But I'd say more and more, there's going to be someone involved. And so we tend to try and really gravitate to, we call them the 1, 2, 3-man bands, whatever you want to call them, where these guys are hungry, scrappy, trying to make a mortgage like everybody else. And they're really good friends for us because they're usually not going out to 200 people. So I'd say, Ross, we're delivering something where we have a really good angle, and that angle is pretty darn tough to resonate in an IC if it's through an auction.
Yeah, I think the best opportunities we've found are where there is actually some type of intermediary involved, but it's not highly competitive, or they're running a process, but it's a poorly run process. I think we've also had success where we're reaching out directly to a company, so we're connecting directly with the seller, but then they're bringing in an advisor. I think we've had closed one deal where it's truly proprietary, but I think there's a lot of challenges just in terms of trying to set expectations with the seller. Obviously, if they've never done this before, they don't understand the process, the amount of sort of information overload. You don't have anyone sort of in their ear telling them what they should or shouldn't push on. So I think the ideal situation is there's some type of intermediary, but it's not a efficiently run, process.
Yeah, we've been all proprietary as well, which is kind of flavored with that 1 and 2 man shop, investment bank, and every once in a while, where you have an opportunity to still create a real meaningful value add for the capital partners you're going out to.
So I would say for the 25 investments we've made, I think 17 of those were proprietary. But we'd actually, in an ideal world, you've got an investment banker running a small process that you're uniquely suited to differentiate yourself in. And so we've experienced that recently with an industry that our first LBO 8 years ago was in, the air cargo industry. And we sold that business after 5 years. The non-compete has expired. We're now looking to repeat that success. And so the investment banker knew about that deal and included us in a pretty tight process. And that was one where we were competing against a strategic. And so their price was higher, but our structure was more advantageous for the sellers. We gave them their rolled equity opportunity, a seller note piece. So they've got a lot of skin in the game, and we're going to try to build to a second exit. So that was a structure that the strategic couldn't offer. So I think we'd love to replicate that every time. Really, really competent investment banker, boutique investment bank, small process. We have an angle that enables us to win, and that investment banker does their job. Because otherwise, if it's pure proprietary, you're ending up doing investment banker job as well, and that can be tough if you're a small shop like we are.
Matt, maybe talk about your approach, but then also, once you've selected that capital partner, how do you manage the process with the capital partner and really that interplay with the seller and exclusivity? Maybe talk a little bit about, and anyone else feel free.
Yeah, I think in the first part, we would love to find out proprietary opportunities. We've been able to for add-ons. It's been tougher for platforms. We did as a firm bring on a director of business development who has an executive recruiting background, and he's his weekly pipeline that he reports to us is how many calls he made, how many outreach he has. It's been great because it's allowed me to focus on a lot more other things. Part of that's execution. That's when we're looking at opportunity, and we're looking at one now that we just went pencils down on. But as I told my team, it's very important that whoever you're going to partner with on the capital side has an update for their investment committee. And that's partly just because the world we came from, that was very important on Mondays. So we try at least once a week through Diligence to share kind of exactly where everything's at, even if we're 2 weeks away from getting any third-party reports, just giving that capital partner something that they still feel connected to the process, because ultimately, once people disconnect, it's hard to kind of get them back on the island sometimes.
Yeah, I think it's really important too, before you sign up with a capital partner, to really try to understand where they're at internally with the opportunity. And I think there's some balance between a partner who has not done enough diligence or hasn't socialized it internally and is kind of really hot for the deal versus someone that wants to kind of do exhaustive diligence before they sign up. I think you need to sort of balance that. So I'd be asking questions like, how much has this been circulated on your committee? What is sort of the specific process to close? What's the timeline for that? If you're going to kill, if we were to sign up for you and this deal is going to die for your committee, what are the reasons why they would do that? That would happen. So I would really try to make sure that you're comfortable with where they're at internally before you're sort of committing to that capital partner.
So then relatedly, Jennifer, as you think about that dynamic, when you get to the term sheet stage, how detailed are you in your term sheets? We've certainly seen some where it's not very detailed and some where it's extremely detailed. What's your approach?
Yeah, so I think it's different with different capital partners. So if you're working with an institutional capital partner, there's really typical term sheet terms that you really work through, and it's a little bit more of a traditional process. When you're dealing with maybe less institutional family offices, for example, we've moved forward on really working on a term sheet via email because that was the culture of the firm. It was what fit in terms of our relationship and their interest in moving forward with the deal. So you really have to understand situationally where you're at in the deal and with your capital partner and what level of trust you have and how you really work through the terms. From a big picture standpoint, typically go down from a medium standpoint where we really make sure all the key economic terms we really understand. And if there's key issues or understandings you want to make sure you understand between role and control, those are really important to make sure you work out as part of the term sheet as well, especially if there's some red lines for you in terms of how you really want that relationship to be.
Mike, have things evolved with George Oak? Is how you think about that, and how do you think about it?
I think they're evolving. I see no issue with detail. I don't care what the trust level can be 100, 10 out of a 10. Who cares? Just back. You're going to have to go through this stuff eventually. Why not put it up front? Frankly, it's better for you as an independent sponsor because it's kind of tough once, you have a signed term sheet, you're down the process, they've met the management team potentially, and now you're going to talk about, big consents that you easily could just have been drafted, a month prior. So I think we are evolving from that. We probably have so in the last deal or two to just get as much detail as possible. Everyone's on, have a little thumb wrestling match on those points then when things are still high and there's still a kind of, honeymoon in the deal. And then once you're signed up, you're just handing that term sheet over to you and your team can easily relay that to an LP agreement. So I just think the more detail, the better.
I guess, Greg, one of the topics that you were really thoughtful about that we've all seen, and for better or for worse, what do you do when the selected capital partner just decides they're not able to do the deal for whatever reason? And how do you manage that process?
Yeah, so there's always a wrinkle or two or three or five or 10, right, in every deal. and so that's the one that is the dreaded, oh no, the capital source is pulling out. I think it's really important that you have backup plans and then backup plans to the backup plans. You need, and this speaks to something that Jennifer said, which is you want to be taking full advantage of every exciting deal that you have, even if it's already funded, to tell your capital relationships about that opportunity. There may not be room for them to be in it today, but it gives them a sense for what you're doing, that you're active, that you're the kinds of positions that you're taking in the market. So this actually happened to us last week. So we've got this air cargo acquisition that I mentioned earlier. we're getting ready to close within the next couple of weeks. And one of our equity co-investors who had committed, to do $1.5 million is going to do $250,000. And so all of a sudden we've got $1.25 million to fill. And so fortunately, we've got some other LPs and some of our other transactions. One of them is being recapped. They're going to be coming out of that. And so they're going to be rolling some of their ownership in some of that liquidity into this new deal. And we've actually mentioned a co-invest opportunity to some of you in this room during this conference. So, you have to be nimble, and you look at it as an opportunity because that gives you a chance to pitch a great investment to someone new, let them know and get to know your firm through that investment, and see if you can expand your capital relationships.
Jennifer?
Yeah, so when you're choosing who to move forward with, I guess just to start out the question, you want to do everything you can so this doesn't happen.
That's right.
And every once in a while you're in that position where you can get better terms from this person, but they haven't maybe done quite as much work, or you're not quite sure exactly, how close everyone is on the committee in terms of being committed, to this deal, versus you have slightly, worse terms over here. But the person has been all over the deal. They understand everything. They've done much more diligence and are super excited for it. Be long-term greedy. Go with, take a little less economics and have a confidence of working with someone that is 100% behind the thesis, behind the deal, behind you in terms of moving forward. But stuff always happens in deals. And I absolutely have been through that experience as well. Backup plans, just to repeat the obvious. Yeah. And I'll say also, if this happens and it's going to take you more time, because it just does, be transparent and figure out the right way to talk with the seller or the investor banker who you're dealing with, so you can manage the execution of what you're trying to do and give yourself enough of a window to replace the capital. And then, I suggest really being upfront and transparent with the new capital you're going out to, because they know you're coming back to them or you're coming to them late. Explain what happened, and be transparent, build trust, and hopefully you have a great deal that's for a great price and you're buying it for a good reason, and you'll be able to fill it.
Jennifer, on the point about really managing the seller, so maybe talk a little bit about those conversations. Lots of people may not have had them yet. I mean, how do you manage the seller through that process?
Yeah, so there's a big difference between having a really close relationship with the actual owner, seller of the company, versus having a really strong investment bank that's managing the process. If you build up a proprietary deal and it's the owner, you already built deep trust with that owner, and you have a little bit more flexibility and capability to really, head on address this and know you have a partner and allowing you to solve it. When you're in an investment banking process, it's tough. It's tough. Sometimes, you have to work really hard to regain the confidence of your capability to execute, and just take the extra time. Explain your action plan, explain all the other people that are interested, and you're going to be able to fill it, and give a real amount of time you need to, do your job on the execution side.
And how much do you see on the capital partner side? Why are you coming to me now? What's wrong with this deal? Talk to us about how you manage that.
Well, it kind of goes back to the transparency, because they really want to know what's wrong with the deal. Because if someone backs away, then something must be wrong. So, hopefully you did all your homework. You're really able to explain, hopefully the capital partner that's backing out, and I found this helpful, can explain why they had to back out. And that, provides some, extra confidence to some of the new guys you're speaking with. And that's kind of has been my experience.
Before we move on, anyone else want to?
Yeah, I think that, the statement Jennifer said about avoiding it, just avoid it. How? It's that trust building. If you're an independent sponsor, your number one job above all else is to build trust with the business owner. And if you establish that early in a proprietary way, you're more apt to navigate any issues in the capital process. And so, what we say, just to pivot slightly, but to say, when we were trying to establish that trust, I'll take Bob out for a round of golf. Yeah, Mike, thanks very much for the round. That was great. But I know 7 investment bankers all say they can, go out and take this to market. And what we say is, look, you're not going to know these people. You're going to go through a process. You're going to end up on a spread. All the buyers are going to end up on a spreadsheet. You're going to have one night, one dinner, maybe 2-3 meetings, and your 30 years is going to be wrapped up into a buyer that you're going to have about 8 hours of time with. And so that's where we lean into relationships. Let's sit in a deer stand. Let's go chase bull sharks in the Savannah River. Let's go to the Rolling Stones show, which we're doing in 2 weeks with 8 business owners. Dear God. And so I think if you've got those relationships built and that is your model, that is your business model, is to have that, you're more apt to navigate any issue that could come up with a capital provider.
I think something else we've done tactically is trying to accelerate our third-party diligence earlier in the process. So we're not waiting until we've gotten really close to when we're closing before we're having a QFE delivered or industry report or whatever it is, so that we're able to deliver those materials to a chosen capital partner sooner rather than later, so that if there's something in that that's going to kill the deal for them, we are ideally having enough time that we can go back to maybe someone who was interested earlier in the process or someone else in our network. But I think having that timeline and making sure you're keeping a buffer is sort of important.
We touched a little bit on using placement agents to raise capital for a deal. Greg, what's been your approach and thought process around whether and how to use placement agents?
So we've considered using placement agents many times on deals, and we've had conversations with lots of them. We've also revisited the idea of raising a fund. Those of us at RLG have been in funded sponsors previously. I started at Bain Capital early in my career. And so that's been a tempting model to go back to. And now that we've had some successful exits at RLG, it's tempting to do that. And I think if you're an independent sponsor looking to raise a fund and that's the direction that you want to go, then I think having those placement agent relationships is helpful. It certainly can expand your bandwidth and perhaps give you access to capital at a quicker pace. It'll get the deal done that you couldn't otherwise close. Our experience has been that though we've had lots of conversations with those agents, we actually haven't used them yet. But we're still open to that. It's been important for us, I think, to cultivate our own capital raising capability. So we have a master fund database, and it's deep. There are 600 capital providers there, and so for any given deal, you're probably going to maybe 20. But having that capability, we also think is extremely helpful. So as long as you're not using it as a crutch, then I think capital placement agents could be great. And of course, if you want to raise that fund, it's a great way to get visibility into getting that first fund started.
Rees, what's been your perspective on it?
Yeah, we've done both. I don't think it's either or. I mean, we've had a lot of success using placement agents. I think there's a couple benefits. I think one is just leverage, particularly if you're a solo independent sponsor. There's so much work that needs to get done. I think having someone else that's sort of managing the capital raise is huge leverage. I think the second, particularly if you're a newer independent sponsor, there may be relationships that should be seeing your deal, maybe interested in your deal that you don't know. So they can put you in front of those folks. And then I think the third reason, which we've also found helpful, is it can be helpful to have someone that's standing between you and the capital partner when you're negotiating key terms or you're having some issue you need to work through. I think having some distance from that through a third party can be helpful. I would caveat that there's capital raisers and there's capital raisers. So I would be very careful with who you use. And so obviously you should be using a group that comes highly recommended. They've done a ton of independent sponsor deals. I think there are placement agents that are have traditionally done blind pool fundraisers that are trying to get more into deal by deal situations. And I think if they haven't done it before or really understand the space, I would be careful about working with a group like that.
What's been your experience, Matt?
We've interviewed several of them and we've thought about it. At this point, we haven't decided to go that route, but we're open to it in the future, especially if we run into an opportunity that might need a bigger equity component than we're anticipating.
I won't ask the corollary about the not so good placement agents, but does anyone want to share a name or two of the ones that you've either used with success or, think highly of? If not, we can move on.
Sim's staring at me right now. So we have over the last 16 months worked with Triago. It's been okay, It's been really good. And it's case by case. I don't know if it makes sense for everyone for a lot of the same reasons that have been set up here, but I think it can help you have a team that's constantly thinking about what's in your long-term interests because they're aligned to that. And candidly, what's a dollar at AUM worth? At a 3x return, your teens are 20% type carry, it's worth 38 to 40 cents. And so if you guys want to have 50 basis points, is that our deal? If you guys want to have 50 basis points, that's really worth it in the long run. When you model it out, it's not 50 basis. It's a little more. So we've had a very good experience with Triago.
One quick word of caution on this topic. So if you broadly define placement agent as any third party looking to raise capital for your deal, I would just, as a word of caution, don't think that if you've got someone engaged to help you raise the capital for a deal, great, I've got that box checked. Because it's just not the case. No one is going to be better at pitching your deal than you are. No one. And so you've got to give that placement agent all the resources that they need and the vision that they need and the understanding of the company that they need so that they can go and be successful. And you've got to then focus on that relationship so that they can then do their job. And that way you are truly leveraging and expanding your capability. Otherwise, you're putting yourself in that scenario that we described earlier where you think you've got a capital source and they say they're going to raise $10 million for the deal, and then they come up short.
Very helpful. Circling back a little bit to building relationships, knock on wood with what we're seeing with this conference and hopefully COVID, but to the extent that we end up in another quasi lockdown, what did you learn during COVID around how to build, how to cultivate relationships where the reality was, for the most part, you weren't getting together in person? Matt?
That's a tricky one because during COVID, we kind of blitzed the small add-on market and we traveled the whole time. We felt like we had to because in healthcare, our frontline workers are going to work every day. So it didn't really feel right for us not to. But as far as capital providers, and we stayed in contact with kind of our core partners. We didn't really look at new platforms. So that probably we took our gas off the pedal a little bit on building new relationships we need to get better at. But I think COVID did teach us all that Zoom's great. But if you really want to build capital partner relationships, I think you need to get to the cities, have coffees and shake hands because what we're selling as independent sponsors is trust with business owners and trust with capital partners. And it's hard to do on a screen.
Greg, were you focused during that period on historical relationships? Did that make it easier? What was your approach?
It did. So it's an advantage to live in Park City for lots of reasons. But one of them is that it's a smaller community that is 95% vaccinated and it has taken a responsible approach to managing the pandemic. So that enabled us to get back to the office quickly. So we did that. So we've been meeting back together in our office since May 4th of 2020. So we've been back. But what we did, to answer your question, John, is we were very focused on the relationships and the deals that we had in the pipeline. There was one in particular that we decided to focus on that we thought would be benefited by the pandemic, and that is an online learning business. And we proceeded to do that deal. McGuireWoods was our legal firm that helped us through that, and these guys are tireless. John was on many of those calls, and they did a phenomenal job. And I don't recommend this, but we bought 3 companies in a simultaneous close. And we closed in April of 2020 when nothing was getting done. So it was a bit risky, but we felt that it was the right thing to do, and it's proven to be a really valuable, platform for us. So yeah, we did continue the existing relationships. We used, the technology, as we all do, to have digital meetings. But I totally agree with Matt. You've got to be, traveling. Site, there's no replacement for a site visit. We're buying a business in India, and guess what? I'm the lucky guy who gets to go to Chennai next week. Or 2 weeks from now. But there's no replacement for the face-to-face in our business, I don't think.
Sure. We just have another minute or two left. Maybe going down the line here. Anything, we talked best practices, but anything we haven't touched on or anything you want to reinforce we can do before we break for lunch?
I would just reinforce that. I mean, we're now in our 5th year of doing this, and it's becoming more clear to me that the biggest learning for us is transparency is key. I mean, if there's going to be bad news, just get out in front of bad news. There's going to be hard conversations. To Michael's point, have them on the front end, because kicking it down the road does not help anybody.
Mike?
I'd say that above all else, if I'm talking again, independent sponsors, you likely have to convince someone to do your deal that you'll never meet, in an IC, right? In order to convince someone of a deal you'll never meet, potentially, you need to have a really compelling angle, a really good story for your deal. It's got to make a lot of sense. It's got to be replicable. Someone's got to be able to go in and tell that story too. And so I think that, 5 out of 10 PE deals closed this week, by committed funds just don't have that story test. So I think there's a higher bar for our deals, candidly, because I think you have to convince someone, you have to convince someone to go convince someone else. So yeah, just work on stories, work on angles, and make sure you've got a good one for each and every one of your deals.
Yeah, I would maybe think about what stage you're at as an independent sponsor. I think our approach to capital raising on our first deal is, very different than how we're going to approach our next deal, which will be our 4th deal. And I think when you're newer, you may need to go out to more people. You may need to go to people that you don't have a pre-existing relationship with. But I would think about the advice you're getting and also sort of match that with what stage you're at.
Always take the time to continue to build the relationships, because at the end of the day, it's all about trust and relationships, and be purposeful in where you want to go. So figure it out and make sure you're making really smart choices on what capital partners you're partnering with to make sure you're going to get to where you really want to go.
So I would say communicate. It's tempting as an independent sponsor, once you've gotten the deal closed, to then completely focus on that company, which of course we have to do. That's our job. I'm assuming that everyone who's an independent sponsor is very hands-on. We're extremely hands-on. We've got a lot of operating experience. We're all about what you do with the business once you bought it, not the buy and the sell. And so that's where we tend to focus. But sometimes we can ignore or forget to maintain the relationships that have provided the capital to get us into that deal. And so I think it's really important that you continue to communicate, that you send those regular shareholder updates, that you act like a fund in that regard, even though you don't have the requirement to manage LPs, that you send out those reports and you let them know how things are performing so that they can feel excited about the business, because oftentimes the whole period is a long one.
It's great. The only other thing I would add, just as a little plug to the panels, one of the things that I love about the independent sponsor community is the collaboration and the collegiality. So truly, if anyone has questions, wants to dig deeper, just reach out to any of these guys and gals. They're fabulous professionals, and I know they'd be willing to be helpful down the road. With that, thank you, panel. Appreciate all the insights. We're going to have lunch started in a few minutes. You're welcome to use the restroom. You're welcome to stay where you are, but we'll get going on lunch in just a few minutes. Thank you.